So welcome to the water cooler edition where we review what's going on in the Interim Goodwill Report. The full link will be available at the bottom of the screen. So if you want to download a copy of the Interim Goodwill Report, it's available now to download. I will go over some of the highlights, but I also thought what's probably useful is to look at how that is being applied in the real world, as anecdotally what we're seeing in the marketplace now. As a result of some of those findings, or should I say causal to some of those findings. I guess the first thing is that the average practice value has risen to 1.458 million in terms of our average deal value. So again, to caveat, the Interim Goodwill Report covers the first 6 months of the fiscal year. So it covers from the 1st of April through to the end of September. For any completion. So it's a smaller sample size than what you get over the whole year, which means by nature you will see some bigger swings. And likewise, the first half of the year in terms of completion volume does also tend to be a little bit lower than the latter half. So there will be some interpretation of that. But even still, that is a big hike, especially when you consider that only a couple of years ago we were saying that the average practice value sat around the £800,000 mark. Now, some of that I think is that some of the bottom end of practices just aren't selling. So that is having a pressure and pushing that kind of value up. But the other side of it is I do think that given the economic and the political climate, is there are people who held on to their businesses for longer, have been able to grow their business because actually the economic climate has been quite friendly to dental practices, who are now taking the time, particularly with a Labour government where we've had 2 consecutive budgets now of big tax rises, and who are taking the opportunity to, if you like, cash in the value of what they've created, if through fear of what may be coming down the line. And I think that's pushing some of the bigger practices, because we're certainly doing lots of sort of multi-million pound deals, which I think is pushing that overall kind of value up. The other point to notice is how that if you then extract just NHS practices, you'll see the average practice value of those is down at 1.15 million. And again, I think that's symptomatic of the sentiment that some of these NHS practices are not in the same colour as to what they were quite a few years ago. But I guess probably one of the analytical points I wanted to look at is that what we've now got is we've got a market where a lot of the tier ones just aren't active. So, Supportman, Dentex aren't in the M&A market. We've still got no Bupa. We've still got My Dentist who are back in the M&A market, but certainly not to the level of aggression that replaced the kind of activity that Portman Dentex were doing. And what impact that's having on the market, because it was always, I think, feared that we needed those big players at the top of the market to give us that trickle-down effect into the rest of the market. But I think the good thing is that, as you can see, multiples are still increasing slightly. So I think our average deal multiple went up from 3.31 to 3.47 on the independent market. What's proved us wrong, if you like, is that actually we don't necessarily need those big players at the very top of the market, because actually the market in itself is quite self-sustaining. If anything, probably our most active group of buyers on the group side are still the tier 4 buyers, which are people who own anywhere between 3 and 10 practices. And as long as you've got multiples of those groups of buyers in the space, and you've got the banks wishing to support them, which I'll come back to in a second, then actually you've still got a market that is self-perpetuating with interest and maintaining the multiples at which some feared would burst when a lot of the bigger groups exited. And I think what's quite interesting is, if you look behind the detail, is that actually if you look at our top 20 deals, the average multiple is around 7.55 times. If you take that up again and look at the top 10 deals, you'll see actually the multiple is nearer the 8 times marker. But tier 1 just aren't featuring, and a lot of that is because with the private equity requirements as they are, they require a much faster term, and they need to be able to demonstrate that they gain value. But simply, if you've got a tier 1 buyer who's making acquisitions in that kind of late 7s market, then it's very difficult now for them to justify to their advisors and to the private equity board that's backing them that they're going to be able to make a sensible return on that number, given some of the recent bigger corporate exits have only been around the 10 times marker. So what you're seeing is the market is largely now supported by smaller groups who are looking at a much longer hold and are considering the value maybe over a 10 to 15 year cycle, or even are building in the EBITDA that they're going to harvest in that 5-year cycle before they themselves exit. And again, I think that's where we're seeing a lot of that in the market. The other point I think to note is that we're potentially looking that we're going to see interest rates go down over the next 6 months or so, and what potential impact that might have. And that's twofold, really. First of all, you've got the base rate issue, where most of us believe, I think, that given the current inflationary environment and given the current economic climate, that we'll probably see relatively modest reductions in base rate now. We've probably only really got another sort of half a turn, so probably 2 base rate reductions, because they tend to do it in course of a percent to come. So I think a lot of that is already built into the market, so we're not necessarily going to see that have a big impact on this Goodwill Report in the long term. But what we are seeing is a lot of the banks who are coming back to market now, really liking dental, because dental's done pretty well over the last sort of 4 or 5 years, is that they are now seeing that that's pushing down the base rate margin that they're able to charge. Which means that whereas before you may have seen a rate that's say in the high twos plus bait when you're borrowing money, you're now seeing rates of in the lower twos or low twos and plus base, which can make quite a big impact. If you think if you're borrowing sort of £1 million, just that 0.5% difference on interest rate, will save you £5,000 in interest. And if you've got that doubled up, so you've got one reduction on base rate and then you've got one reduction in the base rate margin, you can quite quickly see that you've got these £10,000 savings on what it's potentially going to cost to buy a practice. Now, personally, I don't think that's going to have a big impact on the market, and nor do I see it having one. I think a lot of that's already been priced in. But I do think what it does is it changes the sentiment of some buyers who are now prepared to be more gung-ho in terms of the acquisitions that they do, whereas they maybe would have looked at it if it had been a bit tighter before when they stress tested it, and they'll make the acquisition now that they wouldn't have done. So if anything, I think it oils the wheels to create a freer sale, but isn't necessarily impacting the market overall. So as I said, the full report is available to download using the link at the bottom of the screen. And if you've got any questions, don't hesitate to drop us a line.